Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. Now, some weeks in the investment world, a lot happens. Then you get other weeks where it's a little bit more quiet, and the last week has been in the latter category. So if we just sort of backtrack slightly, last week we saw the S&P 500 pushing up towards its 200-day moving average. It was heading up towards that 3,000 level. Now, if you remember, if the index as a whole is above its 200-day moving average, then that's seen as a bullish sign. Below it, where it is now, is seen as a bearish sign. This is sort of a general principle. Now, since then, we've seen the market pull back, and we had 1 or 2 days with not the 3, 4, 5% falls that we'd seen at the beginning of this sell-off in February and in March, but 1 to 2%, which isn't excessive, but it's still notable. Now, at the moment, if I look, we are at around about 2,850 odd, and just a bit above that on the S&P 500, and it's trying to break back up towards 2,900. And on the FTSE 100 by comparison, we were heading towards the 6,000 level, and we broke above it, and we've given a fair bit of that back, and now we're back, as I look, 5,846. Now, if you want to know what the 200 moving day average is on the FTSE 100, then you're looking at 6,838. So it is a long way below that 200-day moving average line, and that just emphasizes that divergence I mentioned last week, where US stocks are trying to push higher at a faster rate and recover more quickly than the rest of the world. So the FTSE 100 demonstrates that quite nicely. Now, the VIX, we had the fear index, I always like to refer to that rallied up towards 40, and then we pulled back, and we're now again around about 31, 32, so still elevated levels, which does suggest that there's going to be continued volatility in the market. And we've had bond yields initially during the week, they fell, but then they've since rallied slightly. So where we are is we had the market look like it was going to push above a key level. We're at a sort of a pivotal point whether we could push on and start to try and recapture some of those all-time highs, but it's pulled back a bit. And one of the catalysts for that was the earnings report of Amazon. Now, Amazon has been one of the big leaders in this rebound. And during the sell-off, during the coronavirus lockdown, Amazon has been one of the examples of companies that have fared relatively well. If you think about your own life when you're in lockdown, it's pretty much the first retailer most people go to. So people were looking at the earnings report that came out on the last day of April. So the 30th of April, after the bell went, the closing of US markets, they released their earnings figures. And the market had, before that period, been very positive about a lot of the tech stocks, the tech giants that have been leading this rally. They've been very positive about the earnings reports that have been coming out, as in they're not as bad as they feared that they could be. Now, they're all looking towards Amazon. It's one of the biggest stocks in the world, but particularly in the S&P 500. And their earnings report showed that they missed their earnings. And more importantly, while revenues had beat expectations, their spending had increased significantly, and that's because they've been spending a lot to try and meet demand, but also the growth of their cloud computing area, the cloud revenue, disappointed. By contrast, Microsoft a few days earlier had done relatively well in that regard. So it meant that after Amazon's earnings were announced, unlike some of the other tech giants where we saw their shares rally, we actually got to the point where Amazon's share price dropped, and actually a week later, so we're about a week later on from that announcement, their share price is down 5%. Now, why that might be significant is going forward, Amazon had obviously failed to set a new high. It's like some of the other tech stocks, but it actually has underperformed the wider market. And that could be a sign in the short term that the market could run into difficulty. If one of the big leaders has started to underperform the wider market, then could it drag down the rest of the index and set something up that could see the market more widely for. We'll have to wait and see on that. But like I say, a lot of the other tech stocks are still proving relatively resilient. And there are a lot of people out there who think that Amazon will come out the other side of the coronavirus lockdown a much better, stronger company. They could be one of the companies that still see their share price grow. So we had disappointment on Amazon that shook the market, which is part of the reason for the pullback. But another reason was Donald Trump. Donald Trump, being Donald Trump, has to try and blame somebody for everything. And he came out and started to make noises around the idea that China was at fault for the coronavirus. And the coronavirus could have originated, according to Donald Trump, from a lab in Wuhan. And so the idea that China is behind the virus is obviously a very politically charged one. And Donald Trump had even claimed that he might use tariffs, we're back into that trade war saga, to punish China. So the idea of a trade war when the global economy is already in a severe decline, be it temporary, obviously caused concern for the markets. But the market isn't being overly concerned, because even if you look at it now, we're still at elevated levels given the severity of the impact on the economy, the jobs numbers. And you have to think there's not a lot of clarity about what's going on with the economy and the impact going forward. Lots of companies have stopped providing outlooks for their earnings going forward. So we could be in for a bit of a shock. So markets are elevated. Price to earnings valuations are elevated and could be even loftier, because if you think if earnings are actually less than people are predicting, then that makes that price to earnings ratio even higher. Now, we've also seen a bit of a capitulation in markets. Now, you remember last week I talked about people were capitulating and some people were no longer betting on a bearish outcome in markets. Well, we had something slightly different this week. We had Warren Buffett. Now, Warren Buffett is known as one of the most successful investors of all time, a value investor. He seeks value in companies, holds them for the long term. Well, over the weekend, he gave an update on his investments. And at the AGM, he announced that he pulled out of all his airline holdings. So he sold all the airline stocks he had, which was a bit of a shock for people. Now, historically, Warren Buffett he'd been a bit averse to airline stocks, didn't like the capital expenditure of airlines, didn't think they provided great value. But in 2016, he went back into them. But he's decided that it was a mistake. And that is interesting in itself. But of course, some people took this as a sign that Warren Buffett was effectively calling the market could go lower, not just in airline stocks. I think you could be slightly over-interpreting that, but it was taken as a negative sign, particularly for those who hold airline stocks, because obviously Warren Buffett is a huge investor. And so when he sells stocks, it has an impact on the wider market. So that added to some of the negativity that was out there in investment markets. And it explains why we pulled back a little bit. But overall, we are still broadly in this kind of sideways trading pattern. We're rallying up towards that 200-day moving average on the S&P 500. We're seeing some upside on the other markets globally, but then we're pulling back again and seeing support underneath. So we've got to see what happens in the sort of coming days and weeks ahead, particularly around the coronavirus, particularly regarding the potential for a US-China trade war, and as the lockdowns globally start to ease. And of course, if we get some kind of treatment for the coronavirus, or it could be the opposite, we see a second peak. So at the moment, we are still in a scenario we've got to wait and see what happens with investment markets. But before I finish, perhaps another illustration of that kind of to and fro in where we are in markets. You probably heard the phrase of as goes Apple, so goes the market. Then Apple's earnings were released on the same day as Amazon's, and by contrast, their share price is up 2 to 3% since last week. So could Amazon bring down the market? Well, you could argue that Apple is actually helping to push the market higher. So it just goes to show there's a lot going on below sort of the headline index levels. So keep an eye on those. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via Twitter, Money to the Masses with the number 2, Facebook. Don't forget to join our Facebook group, facebook.com/groups/Money to the Masses. And you can find us on Instagram. And of course, subscribe to our YouTube channel.